Hi, I'm Judith Paquette, and this topic is the classified balance sheet, Accounting 201. Now, the balance sheet is issued as of a point in time, unlike the income statement and the statement of retained earnings, which are issued to cover a period of time. So think about that. The balance sheet says this is how much cash the company has in the bank at this point in time. So we've been running the balance sheet with a list of assets, a list of liabilities, and the owner's equity accounts. And now we're going to talk about the classified balance sheet. And the classified balance sheet is where we create a series of categories within the assets category. And we create a series of categories within the liabilities category. And we put all the accounts that will apply to those categories under those headers. So you can see we have current assets, long-term investments, property, plant, and equipment, intangible assets, current and long-term liabilities, and stockholders' equity. So what does it mean to be a current asset? A current asset is an asset that a company expects to convert to cash or use up, like supplies, within 1 year or one operating cycle, whichever is longer. Now, most companies, the 1 year guideline is plenty, but there are a few rare industries where the operating cycle can be longer. This could be something like building an airplane, or if you were a wine producer where the wine would be in the cask for a longer period of time than a year. So it's the average time it takes from the purchase of raw material inventory to the collection of cash from customers. So let's look at a company, Cabela's. They are a firm that is a popular hunting, fishing, outdoor gear company, and they have a chain of stores. There's a store in Lacey, Washington. There's a store in Post Falls, Idaho. And they're kind of a sporting goods store with a special emphasis on hunting and fishing. So here's Cabela's balance sheet. And I don't have the 2013 balance sheet yet. It has not been published yet. So we'll work with this 2012 and 2011. So like all balance sheets, there's 2 columns, 2 years. And here are the current assets for Cabela's. And the bold accounts are ones that we've studied before: cash, accounts receivable, prepaid expenses, and we've worked with prepaid insurance and prepaid rent. There are other current assets such as inventory, such as current deferred income taxes, such as credit card loans if you have a Cabela's credit card, and you can see that's a big portion of their current assets. And let's look at the total current assets. These numbers are in thousands, so we're dealing in pretty big numbers here, but let's just call them as we see them. This number is $4,589,000,000 compared to $4,111,000,000. So we have grown. Cabela's has grown in 2012 as compared to 2011 in its current assets. Another category in the assets is long-term investments. So these could be investments in stock and bonds of other companies. They could be long-term assets such as land or building that a company is not currently using. For example, Bellevue College owns land up in Issaquah, and we are currently not building on that land, and we may resell it for a profit. So it is land held for sale or for possible development. So here we go, land held for sale, and it looks like Cabela's had 38 million in 2011, but now they only have 23 million. They had some economic development bonds, and those numbers didn't fluctuate dramatically. Okay. Property, plant, and equipment. You have worked with this. You have worked with equipment. When we say property, we mean land, and plant, we mean building. Could be an office building, could be a manufacturing plant. So they have long, useful lives, but in order to be in this category, they must be currently used in operations. And these equipment and buildings depreciate, and that's allocating the cost of the asset to a number of years, and then we track that depreciation in the accumulated depreciation account. And all of that would go under the property, plant, and equipment category. So again, let's look at Cabela's. They're only showing one line, property and equipment net. And the use of that word net means that somewhere they are tracking the original cost of that property and equipment, and they are subtracting any accumulated depreciation associated with that. And this is the net book value. So if we went to the notes for Cabela's, we would see the breakdown of equipment less accumulated depreciation equals book value. But right here on the balance sheet, the company has chosen not to show us that, and that's completely normal because they are going to disclose that in the notes. But look at this. They went from 866 million to 1,021,000,000. So what does it mean when a company adds to its property and equipment? It means the company is growing. They're opening more stores, they're buying more land, they're building more buildings. So that's a good sign. All right, we're going to switch companies here and look at Facebook and look at something called intangible assets, or assets that do not have a physical substance. These assets are trademarks, patents, goodwill, and copyrights. So trademarks, if you think about the Nike swoosh, if you think about any sort of company logo on the clothes that we wear, that would be a trademark. And if it has value on the balance sheet, it will be reported as such under intangible assets. If a company has purchased a patent, that will be reported under intangible assets. Copyrights, if a company has purchased a copyright, same. And then goodwill, and Facebook has goodwill, and that means that they have purchased another company, Facebook has acquired another company for more than its asking price. I'm sorry, for more than its net value of its assets. So the price they paid for those companies is greater than the net assets value. And why would you pay more for a company? Because of something called goodwill. Maybe they have a good customer base. Maybe they have a powerful brand recognition. Whatever it was that motivated Facebook to pay more goes into goodwill. Let's look at current liabilities. Just like current assets, they have to be something that expires within the coming year. So it's an obligation, a debt the company is to pay within the coming year. And you'll usually see notes payable listed first. We assume notes payable are current liabilities unless the problem tells you otherwise. And then accounts payable. Other items follow in order of magnitude. And the term liquidity, we use that term a lot, and that means what is the ability of a company to pay its obligations that are expected to come due within the next year. All right, so let's look back at Cabela's again, at their current liabilities. We've got accounts payable. We've got accrued expenses, and we have worked with these accounts. We didn't use this title, but we've called it salary payable or interest payable. All of those are accrued expenses. And you can see, unlike current assets, current liabilities has actually gone down. And that's kind of a good sign. It means they've paid down some of their debts. And of course, there's lots of other categories of current liabilities. Gift cards, loyalty rewards, anything that they owe a customer. And you're going to see this, current maturities, current maturities, current maturities, and then of different types of debt. Secured variable funding obligations, that's another word for debt. Current maturities of secured long-term obligations. Current maturities of long-term debt. So you can have long-term debt, but you can be paying it off a little bit each year. And that little bit has to be reported under current liabilities. Long-term liabilities are usually, they're going to have to tell you it's long-term. Long-term, long-term, long-term. We've got deferred income tax here. We've also got it in other places. This particular tax obligation is not due in the immediate future. And we have worked with the title long-term debt. And you can see there's no subtotal. Cabela's has chosen not to total its liabilities. If you needed that number, and you were working with Cabela's, you would have to add that up yourself. Finally, we've got stockholders' equity. And as we remember, companies can be organized as proprietorships, where you'd have one capital account, the owners. They can be set up as partnerships, where you'd have a capital account for each partner. Or they can be set up as a corporation, and that's the format that the form of business that we're using in our class. We use common stock and, of course, retained earnings. Now, all this yellow section is stockholders' equity, and the accounts we've been working with are common stock and retained earnings. We have not worked with preferred stock. We've not worked with treasury stock, accumulated other comprehensive income. Those will come down the road for you. But total stockholders' equity went from 1.181 to 1.375. So it's gone up. Now, let's look particularly at retained earnings. I want to draw your attention to that. When retained earnings goes up, think back to that retained earnings statement. We add to retained earnings if what? If we make net income. So the fact that retained earnings has increased for Cabela's tells us that this company made money last year. We don't even have to see the income statement. We can see it in the growth in retained earnings. We don't know how much because we don't know how much it paid out in dividends, but we can say confidently that they made at least the difference between these two numbers. And of course, as you get into advanced accounting, there are other things that can affect retained earnings, but the simple answer is if retained earnings goes up, it generally means we made income last year. So the stock account, common stock, went from 696 to 705, and then we have this other account, additional paid-in capital. Again, you're going to learn about that in Accounting 202, but the short answer is when the company originally sold stock, this is the additional amount that the stockholders paid above par value. So this reflects the variation in market price to the par value of the stock. Okay, we can see that liabilities and stockholders' equity went up, and most of that increase was not in liabilities so much as in retained earnings, although you can see that long-term obligations did go up here. So that finishes out our discussion of the classified balance sheet. You will need to know how to prepare a classified balance sheet at the end of the quarter, so it's a good idea to have a good understanding of the various categories under the balance sheet, and we will be using them for different ratios as well. Next video will be accounting for merchandise companies, otherwise known as companies which sell actual products. We've been working with service companies for chapters 1 through 4, and for chapters 5 and 6 we're going to switch over to companies that sell products. Thank you.